From Wall Street to Main Street to help small business owners have the same capital as corporate America and give them the same resources as a larger company. We cover business funding, business credit, scaling, business consulting, and much more. Check out the website at shieldadvisorygroup.com. Welcome to the show, The Liquid Lunch Project.
Hey, what's up, everybody? Welcome back to another episode of the Liquid Lunch Project. I am Matthew R. Meehan alongside my partner, the Professor, Luigi Rosa Bianca. What's on tap today, Lou?
What's on tap every day, Matt? It's what you and I are always chasing, and everybody in the audience is chasing the same thing. You know, we want to put food in the fridge, we want to put our kids in a good college, and we're looking for financial independence. That's why we work so hard. That's why we wake up every morning. And today we have Steve Selengut. Steve is going to tell us the path to financial independence. Steve, welcome to the podcast. I got to tell you, you're going to bump some horns with my buddy Matt here. So tell us how to walk the walk towards financial independence, buddy.
I can do that. I'll do my best, Lou. You want me to get straight started on it? Okay.
Yes. So, Steve, give the audience your background, right? Because you've been a financial advisor before that was even a term or a phrase that people don't. You have over 40 years experience. So, why don't you tell the audience a little bit about your background?
Well, I got started investing at age 25. As a kid, I had part-time jobs during in the summers and after school and things like that. And my dad was a real estate developer, so I didn't have a whole lot of problems. And he was successful in North Jersey, a place called Lake Apacong in Northwest Jersey. And he was one of the first big developers there. And he taught me pretty early on that it wasn't necessarily the value of the homes he was selling, that sort of varied with the cycles and so on. But what was most important to him was the income that he was getting by his vertical integration. He would loan the people the money to buy the land. He would loan the people the money to buy their house. He would insure them. He would take, he had all this other cash flow than just selling property or selling the houses. And he said, he told me that, I should start putting money away to start developing income on my own, and he did that for me. So when I was 25, he plopped down this manila envelope on my desk, legal size manila envelope. I opened it up and all these stock certificates came out, landed on the desk, all the, like it was the Dow 40 and maybe 20 others. But I had
stock certificates. Wow.
They're real things. Stock certificates.
This is we're predating the internet here.
I still have a coupon bond on my wall here. It's $100 coupon bond from some old railway company. So yeah, I've been around a long time. So I said, oh my God, what am I gonna do with all this? It was, high five figures at the time in 1970. It was a lot of money. Mm-hmm. So I determined I wasn't going to lose it. I deposited it with a broker, and she actually taught me about what these things were and how it worked and what did it mean and blah, blah, blah. And she appreciated the diversification of it. Every one of these companies paid dividends back then. So the income focus just got right in me immediately. And I studied the charts, and I said, look at this Royal Dutch or GM or any one of these companies.
Can you just spend a minute explaining to our young audience members what a dividend is? Because they're so familiar with all these companies like Tesla and Uber, and they're not familiar with dividends. Can you just enlighten them, please?
Some companies, when you own a piece of a company, you're an owner of the company. You never really get to feel like an owner, but you are. And there's enough of us out there that we really should have more of an influence on these companies. But many companies actually respect us for the money that we've put into them, and they pay us a dividend, part of their profits, every year. just in appreciation of, of us being there with them and for them. Because if we all left, we all sold our stocks, they would have nothing, and the executives wouldn't be collecting their multi-million-dollar salaries anymore. But they give us this pittance on a quarterly basis usually, and it's called a dividend. Utility stocks and other like bank stocks and things like that usually pay a higher level of dividend. Also, older established companies in industries other than tech usually pay significant dividends. There's an awful lot of people who use a thing called dividend investing. They only invest, like I did, in securities and companies that pay dividends, and they do it much differently than I do it. But they recognize two things: it's a source of other income that will eventually grow for them, and it's a clear indication of a company's quality. If it can pay a significant dividend, it's got to have the cash flow to do that. And a sure sign of when a company is in trouble is when it cuts that dividend. It's the last thing that company wants to do. But if it has to do it, there's something wrong there, and it's a good signal that this one may be one you want to get out of. If you're in a company that doesn't pay any dividends, you don't have a clue what's going on inside the company. So, unfortunately, most of your new companies don't pay a dividend until they've been in existence, until everybody's rich and famous who started the company. Then they start giving some back. But that's what a dividend is.
I mean, that used to be the name of the game. You invest in a company, you buy it. You're there. You're thinking there's going to be future upside appreciation, but at least while you're sitting and waiting, right? You're getting paid. You're getting paid something. It's like buying a piece of property. You don't usually buy property for the appreciation of the property. You buy it for the cash flow that it's going to generate, right?
Right.
So buying a dividend stock is essentially buying a stock. And while you're waiting for it to increase in price over time, they're going to pay you the dividend, and that'll be the cash flow from the company.
Right. It's like rent on a rental property.
So, gents, if you have an investment in Facebook, okay, and obviously Facebook increased exponentially over the last 20 years. But Facebook just paid out their first dividend last month in 20 years. And this is $1 trillion company.
Yeah.
So where are you better off in a company that maybe has a cap value of $200 billion, but is sending you that $100 check every quarter, or waiting 20 years to try to get your first dividend?
Well, for my money, you're better off with the dividend payer, because most people, in my first book, I wrote this sentence. I said, most people refuse to take their profits when something goes up. And in my experience, most of those profits on those types of companies usually wind up on their tax return in the Schedule D. Is that the one with the capital losses on? That they hold it so long and fall in love, they wind up losing money on it. I never did that, because when I was studying those charts, I determined that every one of those companies I could buy and sell maybe, over the past couple of years, 10, 20 times a year. I could trade them profitably. And then I had this epiphany on an airplane once. I was flying out to Seattle. I was working in a pension investment department for a company, and I was flying out with the portfolio manager of the defined contribution plan. They weren't 401ks yet. They were just profit sharing or profit sharing savings plans, things like that. And we were flying along, and I was talking to him about the plan that I was in, because I was an employee. And I said, "Why do you have all this Boeing stock? You got millions of dollars in profit. It pays barely any dividends at all. Why don't you sell it or sell some of it and diversify, spread it around, get some more income coming in?" And he said, one of the things you're going to learn in this investment side of this business is that, it's not all economics. Boeing is one of our very biggest insurance customers. And they really like for us to have a lot of their stock in our defined contribution plan. That's why we have so much Boeing stock in here. That's why we're not selling it. We're not taking profits. We're keeping it there. So that light bulb that went off on that plane today almost crashed the sucker. I mean, this was an amazing experience. Okay. So I went back. When I got back, I called Rita and I said, okay, every profit that we have in all these wonderful companies, let's start thinking about selling it. We'll see how much we get. We'll set a reasonable profit target from now on. And when these things reach that target, we'll sell it. We won't look back. We'll buy something else. And if this thing goes down again, we'll buy it again and do it again. And that's how it all happened with me. So in answer to that question, dividends are hugely important, but so is understanding that there's more than one stream of income in the stock market. Okay, there's two streams of income in the stock market. It's the dividends and the profits. So let's say you could find a way to take all those tech stocks that don't pay anything and combine them with other companies, quality companies that do pay dividends, and trade them and get a stream of income at the same time. And that's what's in that book that you see over my shoulder there, Retirement Money Secrets. I explain how with closed-end funds, that's exactly what you're doing. You're buying those same heroes that everybody loves, you know, the Teslas, the Facebook, the Amazon. They're in there, but they're in a portfolio of stocks, and that portfolio has a different, its purpose is different. It's a trust, and it doesn't have the luxury of reinvesting all its cash flow. If it gets earnings, it has to pay out 95% of those earnings. Could you imagine if Facebook or Amazon paid out 95% of its earnings? How many of the little people that own it would have a better lifestyle? I mean, really. But anyway, closed-end funds do that for you. And you're owning the same stocks, the same things everybody loves. And these guys are professional managers. Their focus is to make as much income as possible for the shareholders. I mean, it's a whole different ball game with the same securities.
So when you were managing funds, it was strictly retirement accounts that you were managing, or were you managing accounts that were there for different reasons?
Oh yeah, I started when I was 25. I started managing other people's money, a few 6-7 years later. And I was 31, 32, something like that, 34. And my friends were the same. And that's who I started with. So we were developing portfolios. When I first started, I had 30%. I always felt that I had to have an income part in my asset allocation. So I had 30% in income then. And now at the ripe old age of 78, I have less than 30% in the stock market, so it's gone from 30-70 to 70-30. But yeah, I started with these people, and we worked our way through our entire lives. And then when we got into the 50s and 60s, we started moving from the stock market into the bond market. And about 25 years ago, I started using closed-end funds exclusively for the income area. I was still trading. I was trading stocks very actively until the Great Recession. And at that point, I had, I'm a profit taker, so I always had targets. So I didn't get caught really holding the bag, and I had a lot of income coming in. But as soon as we came out of that, it was like a 12-year rally. It was the biggest rally ever. And I had my parameters for buying was I wouldn't buy anything unless it was down 20% from its 52-week high. Well, every year, the number of shares that, the number of companies that were down 20% from their highs that were also New York Stock Exchange dividend-paying profitable just got smaller and smaller. I got to the point where I wouldn't go near anything that was down 20% because everything was up. It didn't make any sense anymore. So I said, okay, I got to go somewhere else with this. I had been using maybe a handful, maybe a dozen closed-end funds that I had found over the years without even really knowing it. I just got into them like it used to be called Petroleum and Resources. And year after year after year, it would pay out in December. And you know what the oil industry has always been like, the cycles of the oil industry. So some years it would pay literally a $3 or $4 extra dividend at the end of the year, sometimes more, sometimes less. So I didn't even know it was a closed-end fund at the time when I was younger. And then finally I started looking around for more of that similar, and then I got into it. I said, oh my God, this one owns all, every blue chip company you can imagine is in their portfolio. Why am I even messing with this? And this it's paying 7%, and the total dividends of the whole S&P is less than 2%. So I transitioned everybody into closed-end funds. And that's where I still am today myself, and where that client base still is with my old company that was bought up by New Edge Securities. Do you know that one? Parthenon Group?
No. I've been out of the game for a while now.
Yeah.
So I don't know any of them.
So it's a different, my approach is much different. It's totally income focused, but it's not usual where you come into somebody and says, yeah, I trade income securities for a living. Who does that? Bond traders are totally different than what I do, but that's what I do. I create these portfolios of high income, and I actively trade the closed-end funds inside.
Now, can you explain to the audience what a closed-end fund is and how it differs from a typical mutual fund?
Mm-hmm. First, as I said before, a closed-end fund is a pass-through trust. So it will own pretty much the same securities that are in a mutual fund or an ETF, mostly the same great diversification, blah, blah, blah. It pays more income because just like you would in a real estate, where when you buy rental properties, you don't pay for them in cash. You borrow from the bank. That's how you set your rent. How much is my cost and so forth. That's how I set my rent. I make more money than I'm spending. Same way with these guys. They don't have properties. They don't have a lot of employees to pay. They don't have the same expenses as a brick and mortar business. So they buy this portfolio of securities, and then they borrow money, and as long as they can invest it for a higher amount of money. Same like rental properties, same thing. So that's how they get to pay so much more income. But and I've lost track of your total question was. I'm sorry. It's the age thing. I do that.
No worries. How they differ from mutual funds.
Okay, so that's the first differential. They own the same. They not different in ownership, but they're different in structure and purpose. Their purpose is to pass through income to their shareholders, not to grow their market value. I mean, really, if you have to pay out 95% of what you make, how are you going to grow it? You can't grow that market value. That's not how it works, because your net asset value can't grow by leaps and bounds at 5% additional each year. Just can't do it. So the other difference is mutual funds. You can't buy them you can't buy them anytime you want during the trading day. Yep. You say you want them, you get it at the price that they establish, that they manipulate overnight to make the price equal. They add shares, they take away shares. And the same with ETFs are also manipulated, but you can trade them every day.
Yeah, so closed-end
those are the big differences. Yeah.
So closed-end funds essentially trade like a stock. They raise a set amount of money in the beginning, and the whole idea for the fund manager is to increase the value of that closed-end fund, but pass through the earnings of that fund to the investors, right? Unlike a mutual fund where they're usually open-ended and they just continually raise money to increase the net asset value.
Right. The value, it's really, it would be impossible for them to focus on raising the value, because they can't put all that money back in. The only way, when you look at a closed-end fund, if you see that net asset value rising all the time, you know what it means? It means they're not taking their profits and passing it through to the shareholders. So unlike a situation where in the other two, the ETFs and mutual funds, if you see that value rising, they're doing their job, right? If you see that in a closed-end fund, they're not doing their actual job quite as well. So I would be more likely to be saying, wait a minute, I'm worried about that one than I am worried about the one that in a market where we just had interest rates go up a gazillion percent in 2 years, the value, the net asset value has gone down. It couldn't go any way else. It's income securities. They go down when interest rates go up. If that net asset value rises, then I say, wait a minute, they're not giving me the profits that I wanted. I might want to get rid of that one. So those are the primary differences between them. Closed-end funds have several sources of income. I don't think. I guess there are ETFs that can do options trading. I don't think regular mutual funds can. CEFs can't do option trading. Wait a minute. Yeah, they can. Yeah, they can, because they do have portfolios that do that. Yeah, Lou.
So, gentlemen, I'll throw this to the both of you. A small business owner who has the lion's share of his net worth tied to his home and his business, where does he or she start on this path to financial independence? Like, give us a couple of how-tos to get that started.
It's I can give you that with my own story, really, because I developed this portfolio, and with every dollar of profit, every dollar of dividends that came into that, I use asset allocation a little differently. I do it based on how much I've invested, the capital I've invested in each asset bucket. So if every income penny that came in, 30% of it in the old days was going into my income bucket, regardless. And as I got older, more and more of it was going there. So when I got done with when I started my business, I had already been making so much trading and dividends on these things that I was making almost 4 to 5 times more on my investment assets than I was in my salary. Maybe because I had a lousy job, but still, I could afford to leave that, and I was spending a third of my money commuting to New York, so I could afford to leave that and start a business. And subsequently, fast forward 40 years later, and in the financial world, when you get a buyout proposition, they don't give you a check for everything, because they're afraid of competition. They're afraid you might tell your clients to go away to somebody else and stuff like that. So you get a piece of the buyout. And that's in this case, it was relatively, like between a third and a half of what the buyout was. So if I hadn't developed this outside income portfolio, I wouldn't have been able to live. I wasn't getting the income anymore from managing. You manage 110 million. I mean, you can do the numbers at a third of the fee going to me. That was a big chunk of change, So I wouldn't have been able to maintain my lifestyle this past year if I didn't also have a portfolio that was generating almost that amount of money. So that's how you do it. When you are a business owner, you have to begin to develop a portfolio that's going to replace your working income. You have to get those properties that are paying those rents. You're going to have to get that portfolio that's generating income, not just growing market value, because you don't know when you're going to go out of business, whether the market's going to be in 1987 or it's going to be in 2021. The difference between those two places were about, 50, 60%, I think, maybe even more. The market has quintupled since I started this thing. But that's what you have to do. You have to look at the income you're getting in, and you have to start putting some of it aside, and you have to make your professional get income focused, and that's not an easy thing to do.
Yeah, absolutely. What it really comes down to is many small business owners out there, they tend to have all their wealth tied up in their business. And all they want to do is reinvest back in their business. Well, that's not diversification, because if the business goes down,
Mhm.
your legacy or your net worth or your retirement's going to go down too. So the first step that they have to do is, number one, pay themselves first, right? I don't care if it's $100 a month or 10%, 20%, 30% of what they bring home. They need to pay themselves first. And then what they need to do is they need to go out there and actually take advantage of every single retirement or tax savings account that they can in order to prepare for the future, and put a portion of that money away into those accounts. So it makes it harder for them to actually access that capital,
Yeah,
and
yeah,
it's
it's a good
there
point.
for a rainy day when they need it.
It's a good point. It's a good point. I've seen a lot in my coaching now. I've seen a lot of people, particularly, Jesus, one guy I met with a week or so ago had 3 young kids, and they each have these 529 accounts put aside. And the only thing was they're those typical type of funds where they're designed that, well, we hope we have enough market value in there when your kid needs it to pay for the expenses. And the plan was, of course, to take the capital out and give it to the college. So I said to him, I said, well, now you've seen these universes of hundreds of closed-end funds that are paying an average yield of in the 9 and 10% range on average. What if those 529 plans contained those securities instead? You could put less into the 529s yourself, and at 9-10% a year, the amount of money is going to double every 7 years, right? So by the time the kid is in school, there's going to be enough there, and the income will pay most of the bills, not the capital. So we're working on how to do that. We're working on how to do that.
That's a good point, but your client may be in one of those really rigid states
Where
that
you
force
can't.
his hand in where he can allocate those 529 funds, New York, and it's
New
really
York,
tough.
right? If you have to give it to an insurance company to run for you, or if you have to have it in mutual funds, then you're better off running it yourself, and just not worrying about the taxability. You can close-end funds. I have a universe. I call them universe. It's a spreadsheet with all the ones that I invest in, and for people and for myself. But right now, the selection universe for closed-end tax-free funds, the average yield is over 5%.
Really?
Tax-free, tax-free, and some of those are New York, New Jersey, Minnesota, California.
You're gonna have to send me over that list.
I can send it to you, but really,
So, yeah, I mean, you've been through a lot of bear markets. You've seen some of the worst of the worst, right? Over your
I've
time,
seen the
starting
worst.
in the
One
70s and
one of
going through
them,
the financial crisis.
the dot-com bubble for me was not a, actually we went up. If you look at the dot-com bubble was purely like the S&P for the entire year before. I think the statistic was that the total rise in the S&P was on the backs of 7 stocks. The FANG
Yeah.
stocks, et cetera, and a few others. If you look at the advanced decline index for that period of time, declining issues on the New York Stock Exchange outpaced um, advancing issues almost 2 to 1 during that period of time. It was. I mean, all the newscasters are saying that this was the no value rally. You know,
Mhm.
these things never had a profit, never paid a dividend. This was just speculation gone wild. I never went there. I know I've never owned a mutual fund in my life, and I never owned a share on the Nasdaq because everything had to pay dividends for me. I was strictly New York Stock Exchange. So my stocks were not going. I lost clients during that rally because some of them said, "You got to get into tech. You got to get into tech." And I said, "Sorry." I mean, I'm saying Joe, and I mean Joe, a guy who owned a gas station up near me. I said, "I can't. You go ahead, take your money, go do that, and we'll see what you look like 5 years from now." But So I had a rally when that went down. All that money came back into the New York Stock Exchange type companies, the dividend payers. I made a fortune for my clients during that period of time. The other ones, the 87, if you just held tight, and you always have people who think that the world is coming to an end. Yeah, it just happens. You're always going to lose somebody. Some people panic. You can't talk them down off the cliff. But most people you can talk to and you can say, hey, look, we've been in moving markets. The market's always a cycle. Look over the history of things. You got to be in a position to take advantage of whichever way it happens to go.
Steve, it still amazes me to this day that people think the stock market goes up or down. That's not the case. It goes up and down, and people need to realize that, right? Go. We can't go up in a straight line, and we can go down, but usually the downside happens a lot faster and is a lot more ferocious than the way we go up in the upside. If you look at
very true.
I mean, if we look at the last year, I mean, I'm actually, full disclosure, I'm in about 3 stocks. I sold out all my portfolio about a week ago. I'm up 50% in 2 months. It's just, it's not reasonable, right? Mm-hmm. So I may be wrong. I may miss some moves to the upside, right?
No, you're never wrong to take a profit. There's no such thing
absolutely
as a bad profit.
But I'm okay with that, But what still amazes me about you is you were doing this before there was the internet around, right? Before, today people have it so easy. We can go online, we can research stocks, we can look at them. Your clients used to have to call you to get the stock prices because nobody knew what they were.
Well, I was managing it. I had to call the guy to get the stock prices. Oh yeah, and I used the first thing in the morning. I went to this deli. I got a cup of coffee and I got the Wall Street Journal, and I opened up the pages and I went down. I looked at the prices to see what I was buying and to see what I could sell. You didn't have this stuff online. You didn't. No, my broker had to write down everything I gave him and run across the room to give it to the wire operator to send the thing to New York. Really, it was incredibly how we got anything done in those days.
It's amazing how far we've come, right? I mean, some of those publicly traded issues were not even in the newspaper. You had no idea where they traded half the time, right? Yeah, unless you were speaking to somebody.
Well, in my case, it was always New York Stock Exchange. So and dividend, like I said, I was always, for some reason, my wiring got to be, I have to have income from everything I own. So I never had any of those problems. I never bought an IPO. I never had a NASDAQ company. I stayed away from mutual funds. I was strictly with the big board, with the dividend payers and stuff like that.
I have to comment. I think one of the keys to your success is this lucidity and calm that you have by not getting emotional with the game. I mean, some people are chasing the game. They're looking at their portfolio every 30 seconds. You have this detachment that makes you, like, it gives you a calmness that you can observe in an unbiased fashion.
Yeah. You can't fall in love, and you can't think you know something. You don't know. KNOW doesn't exist in the lexicon of finance. But there are 4 things you can do that anybody can do to make their chances of success better. And to have, disciplined set of values set up to know if the quality is there in a security. Like some of mine, we've already talked about them. I won't buy anything that doesn't pay me a dividend. That's a quality test for me. I have to have a diversified portfolio. I've never had as much as 5% in any one security for any client or myself, unless you had some things like a merger, stuff like that. It might happen, and you divest yourself if that happens. So quality and diversification are 2 of the pillars I call of risk minimization. The third thing is income generation that I've also mentioned. You got to get something from everything. I never bought those 0 coupon bond things. I want that money now, you know. And the final one that people lose sight of, and that Wall Street and advisors don't encourage profit taking for a few reasons, and one of them is the threat of lawsuits, because there's a lot of hindsight out there, and lawyers have a lot of it. You know, so if I told you to sell that IBM at 75 and take that profit, and it went to 105, I could probably get sued by somebody who said I should have known it was going to go up another 30 points, you know. So advisors are very reluctant to encourage you to take profits. That's why I'll get coaching clients, and they'll have literally $1 million invested in 3 securities. They may be mutual funds, but I've had a couple that have had hundreds and hundreds of thousands of dollars in one stock. You know, just that's why I don't have any hair in the front of my head, because it makes me pull it out when that happens. But yeah, the disciplined, if you have those 4 things going for you, you can really sleep a lot easier. You know, you don't have to worry about what's happening overnight, or if that plane flies into the building. Your companies are vetted. Your closed-end funds are secure. You've checked their quality, their strengths, and a temporary situation like that is not going to put you under. You know, that's the idea of it anyway. And now with closed-end funds, you have a diversified portfolio of diversified portfolios, so you're insulated. And I take it to an extreme. I'm a diversification nut, so my thinking is that the more different entities that I have that meet all those other requirements, I'm not only diversified in the defensive sense. You know how most people think of diversity as a defense mechanism. It protects you. I've got it to the point where I think of it as an offensive machine. If any sector has a run up, if any individual company gets taken over, I probably own it in one of these funds. So Steve, I figure I'm in there no matter what, you know.
Steve, thank you so much for being here. We want to be respectful of your time. Can you tell the audience how they can find you and where they can get in touch with you?
Well, my website is theincomecoach.net, and the way they should get to me is through that book, though, the one right there. It says Retirement Money Secrets on it, and that's available everywhere. And you can get it for as little as $9.99 in a Kindle form, and I'll give you the $10 back if it doesn't turn out to be worth it. Probably shouldn't have said that. How big's your audience?
Hey, Steve, thank you so much, everybody. That's a wrap of the Liquid Lunch Project. We'll see you in the next episode.
Thank you for listening to the show. And make sure you subscribe, leave a review, and share it with a friend. We'll see you on the next episode of the Liquid Lunch Project.